That's a great plan. That's a great plan. Tyler, that was amazing. I think it's one of the best advices one could give to anyone that's looking to start investing, because we got a lot of people that are very savvy. They already done this, but it's always scary to, at the beginning, to get into it and make that first investment.
I remember when I bought my first England property, I was really nervous. And my wife looked at me, she's like, Tyler, you've done this at this point now for a few hundred investors. Why do you feel so nervous? And I had to think about that. I had to reflect. And the reality is that when you're making a big decision, call it your on life or employment or wealth generating, you should feel a little bit nervous because you're going out of your comfort zone. You are taking a leap. And I think that is for all young investors, I think that is a very natural feeling to have. And in fact, it would be strange if you didn't have that.
Hi everyone, and welcome to another episode of Real Talk. Today we have Tyler Walbourne from REC Canada. Thanks for joining, Tyler.
Thanks for having me, Nima.
So what we're going to talk about is what should investors think about when they're doing their real estate investment plan. And this is why we've brought Tyler on, because that's what he does day in and day out. Just talk about different strategies with investors and making a plan for them and how to execute it. So tell me, how has it been so far, especially 2024? It's been a little bit challenging.
Yeah, and 2024, I would say, and I'm speaking to our portfolio management team about this, it's definitely been an uphill battle in regards to production and transactions. But in regards to the plan building and the current state of the market, it's ebbs and flows. We're just trying to understand how the market is performing, so then we can give the best type of advice to our insiders, to our investors. And as of right now, we just have to take a look at a myriad of different stats, different trends, and different micro markets to try and create these investment opportunities for them.
So let's talk about it. Building a real estate investment plan for anybody. How does it get started? How does one would start it? And, how does it progress over time?
Yeah, and that's a great question, Nima. So I would say when I sit down with a real estate investor or a potential investor, it doesn't matter if they're trying to get into their first property, their home, their primary residence, their first income property, or they're trying to scale in a way where they're getting, 50, 60 doors. I still approach it the same. And the first part is I want to understand who they are. I want to understand, Nima, one, what they have in regards to their passive investment portfolio, what they have in their active real estate portfolio, some of the successes, some of the challenges that they're currently going through today. So a snapshot of today's successes and challenges. And then I want to understand where they want their portfolio to be in the next 5 to 10 years. And I think that that's really important, especially with what I believe we're about to see in the next decade in Southern Ontario's real estate market. We can't just close our eyes and just pick a property and just bank on the appreciation anymore. Sure, that's going to happen, passive appreciation and value growth, as you know, but I also feel like this as well. You and I have been in the industry for a bit now, that we can't guess anymore. And our mistakes in selecting the opportunities that we add to our portfolio will show more in the next decade. So we have to be very selective, and we have to invest with direction. And that's what I'm trying to get out of our initial conversation with investors.
Exactly. So let's start with I'm guessing majority of the people that are watching are going to be the ones that are just starting. As a person that, let's just say, either is renting or wants to get into an investment property, because I've talked to a lot of people that necessarily can't afford what they want. And so many of these people, what we've suggested to them, because for example, someone that lives downtown, works downtown, doesn't want a one-bedroom condo, wants, something in the suburb. So we ended up buying them a townhome further out east, and we rented it for them.
Yeah.
So for that money, they couldn't get anything in downtown Toronto that they liked, but, that's renting. They're renting their place. At least they've gotten into a place. Vice versa. I've had someone that was uptown. All they could afford was, let's say, a small pre-construction. We got them in there. But I just want to know, how do you approach people that are buying their first investment property, and where do they usually start, and where does it go from there?
Oh, sure, yeah. And to start off, in regards to what you said, in regards to, a strategy of renting where you own and investing, that's actually one that I do. I rent my primary residence and I just invest in active and passive real estate. For me, the reason that I did that is exactly what you said, which is, for my way of living, for my family, I have 2 kids, I have dogs. I can't buy a 1-bedroom, 2-bedroom condo, which is my budget, which is a 1-bedroom or 1-bedroom plus den. So what I had to do is I had to drive until I qualified. And I think that's something that's really important, because young Canadians, they have this misconception that they're priced out of the market, that investing in real estate is not realistic for them. But the reality is that the best part about real estate investing, Nima, is that there's a tremendous amount of options. And we just have to find out what that right option is. And how I approach, if I'm sitting down with a first-time investor, I first and foremost want to understand what their living expenses are. I want to understand housing costs. If they rent or if they own, it doesn't matter. What's their housing costs? What's their employment? How long have they been with that specific employer? Who are they connected with service provider-wise? I want to understand everything about them. And then after I understand, their current capital saved, their budget, what their living expenses are, then we can really zone in on a few different either markets or asset types. And one other thing I forgot to mention, Nima, is also it's important to understand what they're trying to get out of investing. And you see, the question I ask actually, and then I'll talk about some scenarios. So the question that I asked, Nima, is, if you can wave a magic wand, don't worry about capital, don't worry about financing, don't worry about area. If you're looking at an investment, are you looking for something that can generate you some cash flow today? Or are you looking for something that has that value growth or that passive appreciation potential? Because you get both that potentially out of an investment, but they do play a tug of war of sorts. Markets and opportunities that offer more potential for cash flow, those are markets that offer little to slow passive appreciation growth.
Yep.
Markets that offer, that snowball effect of value and appreciation. Those are markets that offer little to negative cash flow. So we got to understand what they're trying to get out of it. And then from there, we just build these plans. And then what you really hear when I ask that question, what are you trying to get out of it? Your next investment, is it cash flow or is it passive appreciation? I find with first-time investors, they're trying to get passive appreciation. They're trying to get the snowball effect from happening, to happen, sorry. And the asset classes that you would see there are, first and foremost, you can look into a traditional, duplex, a turnkey duplex, something where you don't have to, just single family home, something where you don't have to put a lot of work into, but you can rent it out rather quickly because it's turnkey. It's going to cover the majority of your expenses, but you want to target areas that have these fundamental factors that show growth potential. So, single family homes, duplexes are one. The other is pre-construction. And the reason why pre-construction is because, one, you don't have to put all your capital down at once. You don't have to get a mortgage for the next 4 to 5 years. And that's, I find, advantageous for first-time investors because they can get, who are typically younger, they can get their life kind of on track and in order so they can go and close on this property in that next few years.
Gives them something to work for.
And still reap the benefits of getting in at that time. So I would say that, right? Asset types that they're looking for are the traditional single-family homes, turnkey duplexes, or pre-construction condos. And they're looking for more passive appreciation type of approach compared to cash flow.
Perfect. Yeah. So that's spot on because I feel like I used to always think, okay, you know what? If I'm buying in Toronto, and I always bought for capital appreciation. But as we go through different cycles in real estate, you realize, okay, you know what? Like you got to mix it up here and there because, if you're just, sitting on things that are cash flowing negative, and if the market is prolonged in, negative state, that what we've had right now for the last 2 years, market has been, hasn't gone up, it dropped and it kind of held steady, then, what are you going to do? But if you're in a cash flow positive situation, or if you're cash flowing, it doesn't really matter because then in a lot of those instances, we'll get into it. If it's a multiplex or whatnot, you just refinance, you get another property and then that's it. Like, you don't have to really stress about the market going up and down because you're not selling.
That's right. And I think it's, especially in today's market, these last 2 years specifically, as you said, I think this is the biggest learning lesson I've ever experienced as an investor, as someone who advises real estate potential clients to invest in real estate. It's that you need direction. You need to have a purpose of purchasing. You can't just buy because. You need to understand what it is you're buying and why, and that it's right for you. But you also need diversification in the types of returns you're getting, because if you have a portfolio that is performing fantastically, with value growth, with passive appreciation, but you are, a negative cash flow state, which means that you're always every month putting money in, that means that you can't fundamentally go to the next stage of real estate investing, which is focusing all your time and energy on it. Because that's one of the byproducts that I think all investors should want to do, which is don't worry too much about, the day-to-day returns, but focus more on growth within your portfolio. You can't keep growing if you're still tied to a 9-to-5 to put money into your portfolio. So you do need to have some diversification. So you can create more of like a self-enclosed, self-sufficient portfolio where the cash flow is helping offset negative cash flow with other opportunities, but in some of these passive opportunity types of opportunities, but the value growth is the one that's, really creating wealth. So cash flow, if you think about it as a car, cash flow is the engine. And then that passive appreciation type of opportunity is the one that's actually getting you to point B or point C, wherever you want to go.
And if you mix and match, if there's cash flowing, you can inject into the other one that's cash flowing negative.
Yep.
The capital appreciation is high. So that's the key factor that you always got to mix up. If you were to recommend someone getting started, should they start with a cash flowing property or should they start with a capital appreciation?
That really depends. It really depends on who they are. I would say, hypothetically, if someone has enough, it actually depends. It depends their age. It depends on the capital that they have. It depends on how much management they're willing to do with the property. Because, the cash flowing potential opportunities, they come with more management compared to something with, something like a single family home or a condo. There's very little management involved there, or less anyways. But I would say if someone is younger, Nima, and they're trying to get into real estate and really build wealth, I think fundamentally what they have to do is they have to pick markets that have signs of pending or of potential growth in population, growth in transit infrastructure, growth in employment sectors or employment diversity. Try to find, regardless of the asset class, try to find opportunities within those markets, even at a higher purchase price, because those are opportunities long-term that will actually truly build wealth.
But those are probably cash flowing.
No, not necessarily, because I think, to preface it, how I analyze micro markets, I want to look at 3 fundamental factors, which is, I just highlighted a little bit, which is the potential for population growth. And Nima, the way to find that out is just drive around, try to see, what developers are doing in that area. Try to find, areas that have pending or approved permits for high-rise development, but not really started in that high-rise, mid-rise, or subdivision type of development yet. But we know that developers are putting money into that micro market.
Great example is Hamilton.
Exactly. But in Hamilton, you're not getting cash flow in most cases unless you're buying the triplexes or the fourplexes.
Aren't you getting good return on condos these days?
You're getting
with their rental, because condos I saw 1 bedrooms hovering around 350, 400.
Yeah, the older condos.
Yeah. You're still there. Well, even the new ones, not new ones, brand new, but I saw a few assignments that they were hovering at around 450. Let's just say price of one bedroom
450,000. Well, I'm sorry, I thought you meant price per square.
No, 450. And and then they're renting at $2,000, which let's say downtown was at 2,000.
Yeah.
Right? But again, 1 bedroom is hovering. You would probably know better. I saw majority around 17, 1,800. There's a lot of 1 bedroom rented for 17, 1,800 bucks.
One bedroom you can get about 2,000 almost.
Yeah. But at fraction of the price you're paying downtown Toronto. So
yeah, but
you're going to be cash. Yeah, you're not making cash flow. You're probably cash flow neutral, because downtown you're negative. Yeah.
If you can find an opportunity, I'm going to look at the camera. If you can find an opportunity first off, contact Nima because Nima's team is going to be able to help build these types of performers and investment breakdown. But if you can find a condo opportunity that's cash flow positive or cash flow neutral in areas that have future high-rise development, star those micro markets, reach out to Nima's team, and those are opportunities that are fantastic. But you do want to just circle back on how to qualify an area as a younger investor to find this passive appreciation or value growth type of approach. One, again, is population growth. The second one is transit infrastructure growth. You want to be able to get into an area when there's plans or current construction to their transit infrastructure improvements. Two reasons. One, values always follow transit. Once an area becomes more accessible, more people tend to go there.
Yeah.
But also it just shows that there's levels of government that are funneling money into or pushing money into those micro markets. And then that last one to summarize is you want to find employment diversity. And that's something I don't hear a lot of advisors speak about, but I think it's truly important to focus on employment diversity in a micro market for two reasons. One is because you get a diverse range of tenants. So the tenant profile is there's a variety there, which is great because, it just shows that you have the ability, even if you say no to a few prospective tenants that are looking to rent your property, there's also, a lineup of others.
Yeah.
But also markets that have, Nima, a employment diversity, they typically don't go into these harsh cyclical appreciation, depreciation patterns. An example of a market that does.
Guys, please hit that subscribe button, hit that like button, and if you find this information useful, be sure to share it with your friends and family.
Doesn't have a diverse employment sector, even though they're improving a little bit, is markets like Edmonton. So Edmonton is solely based really on the oil industry. When the oil industry is performing well and it's booming,
just like how it's been
homes appreciate.
Yeah.
But what happens when that sector is actually on a downward trend? The real estate market is as well. What we're trying to focus as an investor, specifically, investors trying to get into their first few properties, we don't want to see these rough, short appreciation, depreciation cycles. We want real estate values to go up and down upwards. And employment diversity is a way to hedge against some of these rough cyclical patterns.
I'm glad you said that because that's been one of the biggest thing I've always looked for, just investing in any area, because you get a lot of towns that are heavily invested, as you say, like, let's say on a steel mill or like there's, let's say, a car factory or something like that. Like, for example, when GM closed down in Oshawa, I remember people were panicking. And, not much happened because someone else picked it up, but it's just, as an investor, that keeps you up at night. And God forbid something was to happen, then what's the backup for it? But let's just talk about an area you would say is good for investment, let's say in terms of having diversification in employment.
Yeah.
Also, another area that's got, let's say, transit. I just want to have for examples.
Yeah, so I would say a market that we have our insiders looking at right now that shows diversity in employment, that checks off all of our due diligence checklists that we just spoke about, Nima, is markets like, say, Catharines, Welland, Grimsby, Niagara.
What's the employment there?
It used to be blue collar.
Yeah.
A lot of people working in factories, a lot of people that,
I thought they all work in casinos.
Yeah, or casinos. But they're now starting to diversify their employment sector. We're starting to see a flourishing tourism sector, but we're starting to see a flourishing hospitality sector. We're starting to see other tech industries and other
tech in St. Catharines.
Well, they're coming, right? They're coming from outside of like Brantford and Hamilton. It's coming outwards. Engineering firms, there's a lot there. And the employment diversity is there. And one other byproduct that we like in those types of sectors is because of the growth that's happening in Hamilton and that surrounding area, we're starting to see rental rates increase as well. Mm-hmm. And people moving out there because of affordability.
Yeah.
And then if you look at transit, they also have the GO line that's being built as well.
Interesting. I haven't really looked at St. Catherine, but
they're starting to, and it's still in the beginning stages of that.
I saw detached homes going for around like $800-900 on assignment recently. So
you can find So on the resale market, you can find, because, okay, yeah, I'll say first, you can find detached duplexes, turnkey, between 590,000 to 650.
I had one listed for like 690 or something. Yeah. It was right, literally, like you could see the falls from it.
And those ones are
there.
cash flow neutral to like, you know, you get maybe $100, $200 a month.
Well, I mean, like, I think Airbnb is allowed there, right?
Yeah, I did.
Yeah, because we had some numbers, on Airbnb, and it was like bunkers. Like, it's cyclical, but like what you would make during the summertime in that location, it was,
And you can take advantage right now of the price drop.
Yeah.
Right? We're seeing those homes selling at 600, 625.
Yeah.
They were selling at high sixes, low sevens at the top of the market.
100%.
In fact, probably a little bit higher when we saw like the frenzy in February 2022.
Okay, so that's a really good point, because when you're investing, you got to look at different factors that's going to affect the investment property you're buying. What do you think of having backups in terms of what you're going to do with the property? I'll give you an example. Like when I'm looking at an investment property, for me, it's like the highest and best use. So let's just give Airbnb as an example. So if I'm going to an area and I see, okay, listen, you know what? Based on these stats, I can, let's say, make 10% cap rate on this property. But if I rented long term, it would come down to 5-6%, let's just say. I look at it, I'm like, okay, so I can't really just base it on Airbnb, because every day they're changing the regulation. Tomorrow, Airbnb is not there. So what's the backup? Okay, worst case scenario, I can long-term rent it, but there was an area, as you said, there was only one industry there. So I'm like, okay, what happens if this plant closes down? Like, what's going to happen then? Then, like, it's going to be a ghost town. So these are the factors. But when you're telling people what to buy, of course, it's dependent on their level of investment. What do you find right now these days that makes sense, regardless of what the level of investment is?
It's tough, right? So I would say right now, I'm looking into the pre-construction market. And the reason being is that we're not seeing many developers start construction, launch new projects that we're used to seeing, you know, over the past decade. And developers are offering some really lucrative incentives that are investor focused, cashback incentives, rental guarantees, original prices, or in fact, even lower prices. And one of the other main reasons right now is that development is really stretched out. This same project, if I bought something in 2020, you know, that would be a 4 to 5 year window of construction. Right now, I'm expecting if you were to buy something today, that's a 7-year window of construction. That hedges against market conditions. That hedges against interest.
The longer the time frame, the safer.
Because there's one thing you have to consider with longer construction timeline is that you have to be in a position to get a mortgage at the time of completion. For me, I'm great. I'm okay with that. So that's one that I'm looking at. Another one is something we already spoke about, which is looking at like turnkey, you know, residential opportunities, those duplexes, those triplexes. Find something that the lot permits potentially adding in an ADU, an accessory dwelling unit. Not necessarily, Nima, that, you know, I would or we would have to do it today after we purchase it. But I think that's good. It's a good option to have, talking about contingency options, because you can force appreciation. You can create cash flow as well in the future as we see average prices rising. Yeah. Because I think both you and I agree that, you know, regardless of what we're seeing in the market right now, if we look at it, you know, 10 years from now, 2034, 2035, we will see the market appreciate.
Yeah.
And
we're going to look back and we're going to be like, why didn't we buy more?
Yeah. But I do think that there's a fundamental threshold where we're not going to see 5, 6, 7% growth annually in value or average price. And I think that's when we reach that, like that $1.8, $1.9 million mark.
Yeah.
And then we have to ask ourselves at that point, what is the right investment? And the right investment is when you can change the fundamental asset class of that. You can convert your single family home to a multiplex.
Yeah.
Because you're now forcing the appreciation, you're creating cash flow, and we can look as investors right now into those types of options to prepare for that time.
Yeah, that's exactly what I was looking for, because at each stage, there is so much growth that can happen.
Yeah.
And as you mentioned, okay, you know what? You can have an option on a property that you can add a, let's say, garden suite, and you have that option when you're even selling it. You can advertise that option.
Yeah, exactly.
It's just like
plans in place.
Yeah, it's just like a lot of investors that I buy properties for, even like homeowners. I tell them, listen, have that separate entrance, have the walkout, because, and I'm not saying you should rent it out, but down the road, property like that will have more resale value as opposed to the one that doesn't have the separate entrance. And that's exactly what it is, just having the back, having the option.
It's just always good to have the option as well. If you're going through a time especially if it's your primary residence, if you're going through a time in your life where you have some uncertainty at work or in life, health,
yeah,
it's good to have the potential to at least offset the loss of income,
100%,
loss of employment.
And another thing to also mention is when you're investing in multiplex, or if you have a duplex, or even like as small as a duplex, the good thing about those is when a tenant leaves, you're going to still have someone else paying portion of it. If you have a 10-unit apartment, 1 or 2 leaves, you don't really notice it. But when you have a house, the tenant leaves, you're going to have a month vacancy. I mean, right now, the vacancy rates are low, but there was a time, and I recall, I would tell all my investors, you're buying this, first of all, till the closing. We can't advertise it. Once we get it, then, account for a month and a half. And I would see some people start to sweat. We're like, oh, what if it gets to 2 months? I'm like, listen, it is what it is. But when you have a multiplex, the risk of that reduces.
It does. And to touch on the pre-construction side, we've also had 5 years to save up a cushion.
Yeah.
And I think that's really important for the investor or the purchaser to understand this. You have to have a contingency fund.
Yeah.
I know a lot of people recommend 6 months, but in today's, economy,
6 months to be able to carry them.
6-month carrying costs, right? That includes your maintenance fees, your property taxes, utilities. That might be unapproachable for a lot of young investors trying to get in.
Yeah.
That tells me 2 things. One, maybe, okay, if you don't have 6 months, try to save up at least 3 months. Or the other thing that tells me is that maybe this market isn't right for you. Let's go look at some other options.
Exactly. You don't necessarily have to buy in Toronto, GTA.
I just produced a piece of content today, which is 3 common errors I find buyers make when they go in and buying and looking for their primary residence. And the number one mistake I see, Nima, is that they're trying to keep up with the Joneses.
Yeah.
They're buying real estate that should not be open to them to purchase because they're not there yet to go buy that.
Yeah, that's so true. And again, one thing I always say, the interest on your primary residence is not tax deductible.
Yes.
So,
but you could say the same thing with income properties as well. I think something else that is felt, and I think is a learning experience for a lot of investors right now, is you have to understand when you're refinancing and you're taking equity out of your properties that you are assuming debt there.
Yeah.
And you have to now, hopefully the learning lesson is that when you are leveraging growth in your asset, you have to do it in a way that you can stomach those expenses, the added debt. You have to invest and leverage smartly, and it goes back to having direction in your portfolio. Don't just do this, take out the equity and go buy a duplex because that's what your friend told you to do.
Yeah.
It might not be right for you. Maybe what might be right is holding it for 2 years, still look into like passive styles of opportunities like REIT style investments or private lending types of opportunities for 2 years. At least have your savings work for you a little bit and wait for your principal to go down a little bit.
That's 100% true. I was talking to a few of the clients that we talk, and we have that real estate action plan discussion with them, talking about the whole REIT option, and a lot of people don't know it. And I'm like, listen, you can literally, instead of you going and building a project, invest. You got 20, 30,000. Don't let that sit in a,
your saving
account,
GIC
or GIC. Go invest it there. But anyways, I mean, let me ask you 2 last questions. One, if someone was to invest, doesn't matter what it is, where would you recommend location-wise to invest in right now, 2024?
So I'll break it down with asset classes. So if you're looking at pre-construction, I would look at, honestly, Pickering. There's tremendous amount of development happening there. I would also look at Toronto, to tell you the truth. If we're seeing like price per square foot around like $1,400 price per square foot, because I'm noticing developers are lowering the prices there and offering some great incentives. And then if you're looking out to the west, Oakville, Burlington, there's some good options there. We just have to be very careful about the price point
Exactly.
entry there.
Great.
If we're looking at single family homes, duplexes, triplexes, try to look at markets like Hamilton. That's a great market, just because you can cover your expenses, get some turnkey options. The rental market and the real estate market's growing. I've already said it, St. Catharines, Welland, Niagara. And then I'll throw a wild card out there. If capital is a constraint and you're not going to be able to get approved for like a $600,000-$700,000 purchase, try to look into markets like Belleville and that surrounding area there, Prince Edward County, like around there, Tweed might be a little bit too far, but Belleville specifically, because they're having an Amazon distribution plant that's currently being constructed. It'll add a little bit of a boost to their local economy as well. It'll just bring some population there, and you can get in the fives.
Second question I have is, let's just assume you got $1 million to invest. Would you buy one property with that $1 million, or would you divide it up?
I would diversify that for sure. You don't want to put all your eggs in one basket. I would diversify that. I would probably look at, regardless of how much capital you have, I would look at percentages, and I'd probably break it down into like a 10% on one, 25% on one, 15% on one.
On one meaning asset class?
On a type of opportunity and asset class, right?
Okay.
So I would do, first, if it's $1 million and you don't own anything, any physical real estate, I would first look into dipping your toes in the water, buying a duplex and a pre-construction at the same time.
Mm-hmm.
Okay, so and then you got to plan. You got to build a laddering plan with that amount of capital, because
let's make it realistic. Let's talk about like $200,000, $250,000.
No, but we could do the $1 million, and the 200's the same, because I don't look at the amount of capital.
Yeah.
Unless you're talking about like 120,000, because then you can only buy one.
Yeah.
But if you're talking about enough capital where you can buy more than one, what you want to do actually, regardless of asset classes, you want to actually stagger the maturity dates on the mortgage. So you actually want a time when you enter into the market with the capital, because what that does is, one, it gives you the opportunity to hedge, Nima, against interest rate turbulence.
Yeah.
It also hedges against life changes like employment, because think about it. Let's say you have 3 mortgages coming up for renewal in and around that, a 2-month, 3-month window. If you can't, if your job changes or you've just lost your job, it's going to be really hard through the renewal process to keep those properties. But as well, what it does is it gives you different entry and exit points if you're looking to leverage the asset through like a creative financing, refinance, or home equity line of credit, or when you're looking to sell, to shield against some tax, tax to pay out.
Yeah, and that would be done through buying pre-construction, I'm guessing.
Yeah, so what you can do is, let's say you have, let's just say $250,000. Okay, $250,000. What you're going to do is you're going to be putting $150,000 down towards a turnkey duplex. You can look into markets like Welland, Grimsby, something where the price point's around $550 to $650.
Yeah.
Okay. You're putting that there, and then you're buying and then at the same time you're looking at a pre-construction opportunity as well for that remaining $100,000. And the nice thing about pre-construction is, for 4 to 5 years,
you don't have more.
You're not doing anything, right? Other than paying off those incremental deposits. At the same time, you're allowing this duplex or triplex that you purchased. One, you're gaining experience from being a landlord, managing tenants, managing properties. But for 5 years, I'm recommending not touching the asset at all. Don't refinance. Don't sell or offload. Just have it in the mind that I'm going to hold this for at least 5 years. And at that 5-year mark, when it's time for the condo to close, you can do this wonderful thing potentially of taking out the growth of income property duplex, paying yourself back that 150 or whatever that you put in towards that condo at that time. And now that condo is paid for by you timing and time in the market. And now you can use that capital to go invest somewhere else. If you're okay with keeping your money in the condo, what you could also do is at year 5, go and buy another income property, another duplex, another pre-construction, whatever one that you like at that point. And then you're really creating the strategic laddering plan of investing.
I think that's a great plan. Tyler, that was amazing. I think it's one of the best advices one could give to anyone that's looking to start investing? Because we got a lot of people that are very savvy, they already done this, but it's always scary to at the beginning to get into it and make that first investment.
I remember when I bought my first income property, I was really nervous, and my wife looked at me. She's like, Tyler, you've done this at this point now for a few hundred investors. Why do you feel so nervous? And I had to think about that. I had to reflect. And the reality is that when you're making a big decision, call it your on life or employment or wealth generating, you should feel a little bit nervous because you're going out of your comfort zone. You are taking a leap. And I think that is for all young investors, I think that is a very natural feeling to have. And in fact, it would be strange if you didn't have that, those butterflies in your stomach when you're making that decision. That means you care.
Yeah. Thank you. Thanks a lot for joining us. And guys, thanks for watching. If anyone has got any questions, be sure to send us a DM. I'll put Tyler's contact information down below. And be sure to watch our last episode with David Chinelli, just talking about, how his business got started in real estate. And please make sure to subscribe. And if you find this information useful, share that with your friends. Thank you, and we'll see you again.